Good afternoon, and I guess I think it's an interesting topic, multibaggers. Okay, so basically just to set context, I think for investors, multibagger is basically a stock which can actually double, right? So what I believe is, while you're looking at investments and when you're looking at returns is only an outcome, right? So the question is, what do you do to achieve that? And we believe whatever you do has to happen at a stock level, right? And if you're able to achieve that at each stock level, then performance is a natural outcome. Okay, and that is something that we believe about. So we'll get off straight to the presentation. The next slide, please. Thanks. Okay, you have the change again. Yeah. So to start off with, actually, one is you have bottoms-up parameters, but also you have a few of the top-down, and it is looking at, what are the economic trends, what are the government policies, and, stuff like that. There's a lot of conducive environment towards it. I'll run through some of these slides initially and a little quickly, because I'll spend time a little bit more on maybe case studies, right? So, and we have a short, time out here. So there are a lot of things which are happening right from the PLI, right from, the infrastructure and stuff, unimaginable in terms of, the quantum, if you look at from the past. The second aspect is, coming back and looking at, what are the demographic, what are the consumption trends. And that is something which is interesting. If you look at India, I think it is a very, very interesting place, right? So if you see that, where you are today versus where you are likely to be, okay, you are going to find that we are going to become a lot wealthier country, right? You have a lot of people, going up, the value chain, okay? And that is, I think, going to lead to a lot of consumption trends. And those are some of the things, if you're able to leverage, I think, you get that. And this just to give you an example of, how, let's say, developed economy typically sees it, right? So how the US and, as it moved up, in terms of per capita income, how new sectors emerged, how, the premiumization and new sectors are ones which, if you're able to get in, then you can make, good money out of them. And again, if you look at, grocery retail is at a 6.5, but say a non-grocery retail is at a 12.2%. So the point I'm making is that, while you're doing whatever you're doing, if you're also able to look at it, from the trends, okay, demographic dividend that is coming through, likely to come through for the country, I think that also gives you the tailwinds to achieve some of them. And the other part of it is, looking at sectoral focus themes, and I'll probably take it along with an example. I'm just saying, if you see renewable energy is a theme, right? So, how do you then utilize this and see what are the companies that, probably will benefit from such a theme. Now, the issue that you have is, it's not all the time that new themes will make money, right? So you have to go back and see which is monetizable. Okay, if you go back and see today, let's just take an example of AI as well, right? Globally, a lot of the ancillary companies or the infrastructure companies around them are actually making money, right? We still have to see how companies who actually, do the AI codes and actually provide those packages of software, actually how they are able to monetize for the amount of investment that they are making, right? So that is something that, we need to look at while it is emerging. I'll give an example which is closer. Solar, for example, where people did solar manufacturing and all of it, a lot of companies actually end up going to default. Okay, the trend is there, right? And definitely solar is there, but the prices are falling so much that, are you able to make money on it? Are you able to manage it at the scale? Are you able to compete with China, for example? And those are things that you sort of look at. And the other is about, so what are the themes, for example, that we are comfortable right from, we're reasonably domestic oriented, because we think that is where the opportunity is, for the future, and that's what will probably do better. So right from, manufacturing. 2, if you look at hospitals, that's interesting, including on the healthcare, we took hospitals, right? Because again, it's going back to the domestic consumption type of a thing. Consumer discretionary, renewable energy, we already spoke of. Okay, building materials has been something which has done well for us, and obviously financials. Again, within financials, there's some pockets that we like. Okay, pockets like wealth management. Okay, so that's something that we have done. So if you get the sector also right, okay, then your ability to get some of those tailwinds to sort of push you further, and but all of it I think comes back to a little bit of hard work. Okay, so because you just cannot identify a theme, and if you want to run a portfolio of your own as well. Okay, a lot of linkages that you have to bring in, and I think what we try to do is bring in a structured investing process, because our view is in terms of when you look at a structured investing process, okay, then you actually make it harder for you to invest. Okay, and when you make it harder for yourself to invest, okay, you probably get better quality. Okay, so our whole investing journey that we look at, is to look at right across a screener where from the whole universe we screen into maybe 125 odd companies. Okay, then we come back to a deeper dive, which is a scorecard. There, the companies that have come through, we actually do a ranking on almost like 25 plus parameters, and some of them it could also be parameters like corporate governance, where we may give a ranking to it if we are not able to get certain metrics. So obviously, there are some metrics that can come in which are quantitative, but if not, we try and bring in a ranking from ourselves. So valuation can also be one. In cases like that, when valuation is higher, we give a negative ranking. So what we are doing here is, we are not a quant fund. So this becomes the base for us. Okay. So now we have a better quality set. Now from there, you have to build your portfolio and say, okay, how do I look at different sectors? Am I getting overweight in one place or the other? Okay, because what could happen is when you do a ranking mechanism, you may find that, say, A sector is doing well at this current point, so it may come up in a lot of the metrics. Okay, but the more important part is, if that is the foundation, if that's the base, you have to go back and look at what is the company doing, what are its strategies, right? So what are its moats and stuff like that, and what is competitive advantage? How is it able to maintain pricing? Okay, so all of those factors then help us look at, okay, so can this company grow earnings at a certain level? And when we do our projections, are we able to see that in our projections? Okay, so that is something that we do in a second one. The third is about risk. Okay, because for us, our whole focus is around delivering a risk-adjusted return. So we have full process for risk management. Before we touch any stock, we will do a limited forensic, and even on a continuing basis, we track various parameters. So that's risk is very, very important, because you also need to see that you don't have accidents, right? And sometimes if you have accidents, the impact can be very large, right? And the last is about RH pendulum, which is more looking at valuations. What's the point of entry? What's the point of exit? Okay, I think it's, if you're able to, you need to get both reasonably right. Okay, you cannot get it perfectly right. Okay, but the ability to get in at the right time, or ability to get out at the right time also can result in, superior performance, or it can also help you not erode your capital. And we took it further, and this is where, so that was the base. So we said, okay, I come from I have a bit of a technology background in terms of having worked in Wipro, and so that is something that process is something that comes in, and Multibaggers was a style that in my investing journey, from my 12th standard days onwards, I was focusing on Multibaggers. So it's come the whole circle. Okay, and so I said, okay, now how do we make it as a process? Okay, and actually it's a very simple process. Okay, so if you go back and see, there are two things. One is that can we look at a company whose earnings can double, let's say over the next 3 to 5 years. So if earnings can double over the next 3 to 5 years, my expectation is, even the share price is likely to double. Okay, that's the first. So we have a minimum base that we have there. And the second part of it is, can we see a PE expansion, which is the valuation, right? So is there scope for a PE expansion? If one can see both of them, then you probably will, end up seeing a multi-bagger, and probably not just 1x, then you will have more than that, okay? Of course, this is just to demonstrate how, something like this works, okay, with examples. Now, when I'm giving examples, I'm not necessarily giving a recommendation. Some of the stocks I may not be holding, okay, so, and we may have sold as well, but we are having it for, illustrative purposes. So, just to give IRCTC, for example, when we first invested in it, it was at a P of 35x, okay, and when we exited, it was 105, okay, so that was the thing that is there. So, if you go back and see, only from pre-expansion, you had a 3x, okay. Earnings also grew 2x in that period, so which is why we got a 6x, right? So that is the point that one is trying to say. And, the question is, have we got it right? Have we got the methodology right? And that's the great part. We have some 20 companies plus which we have seen, as multi-baggers in the 3 odd years, that we brought this process in. Okay, so just to give you a few case studies, and just to see, for example, KEI has been a very, very big multi-bagger for us, okay, and again, when we looked at it, the earnings growth was, 2.3x, multiple re-rating was very, very good, 6.4, okay, so it was a great thing for us, okay, and similarly, if you look at Sky Gold, okay, that in a shorter period of time as well, you saw earnings growth, doing very, very well, and you also saw multiple re-rating out there. So again, the type of companies, if you see broadly domestic, leveraging some of the trends that are coming in. Of course, something like this was a contrarian bet that we took, okay, may not be in line with theme, okay, but we had a very, very good exit, and I think for most investors it was short term, okay, so when something went up and obscene level, some 4x in less than a year, I didn't even wait for it to, cross the 1 year, because I got very uncomfortable at that point when, it was just vertical going up, at that point I said, I think let's get out and, conserve capital out there. So that is something that, once in a way, we would do some of these contrarian bets where we find an opportunity, but, where we have some bit of conviction. Okay, so, and, every time it's about return, right? And I think that, it's important to stop and look at risk, okay, and I think it's very, very important for us to look at risk, okay, and especially if you're looking at, say, the small caps, for example, if this is a return if it's 16% return in 10 years, if you go back and look at, if you're in the bottom quartile, you almost got nothing, no return, okay, 2.2%. And of course, if you got it right, it's great, okay. Now obviously you cannot get all of it right, so there will be somewhere in between, if you get it reasonably well. So quality is very, very key in terms of, when you're looking at small caps. It's also important to be able to also do a little bit of a touch and feel, because sometimes I joke that, you don't know if the factory is actually there. It's maybe on paper, right? Or it may not be the form that you think it is, okay? So you have to be a little more cautious when you go to smaller cap companies, because there's not as much visibility, right? For larger cap companies, because let's say of the size and their number of employees, and if there's something negative, it will come out, there. But that's something that one looks to do. And obviously, when you look at we also believe you can get alpha through managing risk, okay, right? From looking at business risk, valuation risk, corporate governance, and one slide on super value as a portfolio, okay, which sort of runs on this theme, okay, and what we're really happy about is sort of the rolling returns. If you look at it, 1 year rolling returns has been sort of very, very good. And I think it's important to look at, these are the sort of metrics of the underlying companies, right? And I think, again, so which is what my point is, if you go back to the basics, if you go back to saying, okay, what do I have in my control? Okay, what can I do to actually see that I get the best companies out there? Okay, and then automatically you will find that, the outcome is of performance.